It's time to do another video on the metals. With today's move in gold, there's pretty much no doubt at this point that this was a yearly cycle low, and we're now in the advancing phase of a new intermediate cycle. And the fact that gold is trying to break through this resistance here at 1200 on its first try is a pretty strong signal. So um, let me go to the currencies first and show you what's happening there. So I've got a chart here of the euro, and if there's any trade that the market considers a one-way trade that could never reverse, it's dollar up, euro and yen down, and I just don't think that's the fact. All markets, uh, no market goes in one direction indefinitely. They all have pullbacks and corrections. And usually when everyone becomes convinced that a trade is a one-way trade and it can never reverse, the fundamentals are just too strong, and the trade will continue in whichever direction it is, up or down. And definitely that's right about the time you either run out of buyers or you run out of sellers, and then you get a big move in the other direction because everybody is on the same side of the boat, and so everybody's is about to get caught on the wrong side of the trade, which usually uh, lends a lot of force behind the opposite move. So it in the similar sense that gold has put in its yearly cycle low, I think the euro also did the same thing. It occurred about a couple weeks after gold. I think gold it bottomed right here on this spike down in the euro on 12.15, and then the euro turned sideways and is now starting what I think will be a new intermediate advance. We're in a first daily cycle. We're only, what is this? About 6-7 days into this cycle. So this daily cycle should be right translated, which would mean that it should rally at least, well, considering that the currency cycles have evolved much longer than they used to. They're running about 35 to 45 days now. So a right translated cycle should rally at least 20 days. So we've probably got 2 or 3 weeks yet before this daily cycle tops, and I would expect it's going to at least reach the 38% retracement and maybe the 50% retracement up here before this first daily cycle tops. So that would imply that the dollar probably has 2 or 3 weeks to fall here before it finds its daily cycle bottom, and there should be one, maybe two more left translated daily cycles down before the dollar finds its final intermediate bottom. I know a lot of people said I was wrong about the dollar and it can only go up, but I am not going to be wrong. The dollar will have a move down into an intermediate cycle low. It's probably going to be a pretty severe move because 2017 is the timing band for a 3-year cycle low. So, the intervention in the stock market that also turned the dollar around, because right here the dollar was in jeopardy of rolling over and starting that move down into the 3-year cycle low right here on the election. The intervention in the stock market also turned the currency markets around. The dollar got a brief reprieve and managed to make one more leg up, but this is not going to change the move down into the 3-year cycle low, in my opinion. It gave it a couple extra months of upside that it wouldn't naturally have had, but it's not going to change the ultimate end game, and the dollar is going to have a very hard move down into its 3-year cycle low between now and, let's say, May. So I've drawn in the intermediate trend line, and this trend line should get broken. It actually they get broken about 95% of the time during an intermediate decline, and it doesn't matter what asset it is, whether it's the dollar, stocks, gold, whatever. Intermediate declines almost always break the intermediate trend line. So it's unlikely that this move into the 7-year cycle low is going to end until the dollar goes below this intermediate trend line. And I'm going to also suggest that the move into the 7-year cycle low probably isn't going to end until sentiment becomes bearish on the dollar. And the last time we had any real bearish sentiment in the dollar was back here at this 3-year cycle low in 2014. We got down to about 25 or 30% bulls, and then we haven't. None of these corrections in the dollar have triggered any kind of bearish sentiment. Nothing below 45 or 50% bulls at any of these corrections, and a multi-year cycle low, in my opinion, will not form until sentiment drops below 30% bulls. So my guess is that some point here in 2017, the dollar is going to fall far enough and long enough to turn sentiment bearish to 30% or less bulls on the dollar. That may mean that we have to break below this low here of May of last year in order to do that. That would be my guess. So, the dollar got a brief reprieve here by the intervention in the stock market. It salvaged this intermediate cycle, which was in the process of rolling over and starting that move down into the 3-year cycle low. It allowed it 2 more weeks or 2 more months to rally, managed to break out above this double top here, but I don't think it has staved off the 3-year cycle low. I think it's just all it did was it just got a lot more people bullish on the dollar, a lot more people on the wrong side of the boat, so that as we do move down into this 3-year cycle low, it's just all that many more people that are going to be caught on the wrong side of the trade, and it's going to add force to this move down as this really starts to get underway. And so I'm going to say the same thing about the gold market here. The natural bottom was back here in October. We started the next intermediate advance, but then it just got derailed by the intervention in the stock market that turned the stock market back up and gave the dollar a couple extra months to rally that it wouldn't have normally had, which of course had a disastrous effect on the gold market. But I don't think this is, there was no fundamental change in the currency markets or the gold market. It just extended this intermediate decline, but it hasn't stopped the bull market. And I suspect, when we're already seeing it, we've got a very powerful V-shaped rally out of this bottom as the gold market has put in this yearly cycle low and started to resume the bull market. So, again, I'm going to say again that traders are going to learn the lesson of how bull markets work. Any long position in a bull market will ultimately get rescued. The vast majority of traders are not going to make anything off this bull market. You can just see it by the comments on virtually any blog. Retail traders are basically day traders. They're governed by their emotions. They almost never look at the big picture. So they jump in and out of positions. Let me show you another chart here real quick. So retail traders are driven by charts and chart patterns and indicators. But markets are driven by the banks, pure and simple. The banks are the market. The rest of us are just cannon fodder for the big banks. So you've got a classic example of what I'm talking about here. We've got a breakdown here on the rate hike. Uh, this breakdown had nothing to do with fundamentals. This was purely an undercut low manufactured by one or two big banks to um, trigger stops for retail traders and hedge funds so that they could scoop up shares and then get into position for the next move up. And this move is going to be big. I suspect we're going to go above this August high, maybe well above this August high before this intermediate cycle tops. But this is how retail traders and hedge funds trade. They watch charts. The banks create the charts. So you've got a classic example here of the banks creating an undercut low to trigger stops, get everybody to sell so that they can scoop up their shares, at the bottom cheaply, and then get in position for the next run up. So this is why most retail traders aren't going to make any money in this bull market. They're governed by emotions, they're governed by charts, and they just cannot grasp the concept that these charts are painted by the banks for their benefit. And so they get stopped out during moves like this, and they just never ride these moves. I was watching the internet, the blogs. The vast majority of people missed most or all of this move. A lot of people were trying to trade dust during this move and wiped out their portfolios. And at the time, when this happened, I said, this is probably a manufactured move here to allow the banks to get into position for a big move up and trigger stops of retail traders and hedge funds. And you can see that's exactly what this was, the same as this right here. So, you can try and short term and day trade this thing, but that's not where the big money is going to be made. The big money is going to be made just holding on through intermediate degree rallies, or just holding old turkey through the yearly cycle low. So, I'm sure all of you have seen the articles and stuff, um, about the 3x leverage funds, how people had destroyed their portfolio. But I'm going to tell you that, we bought our position at 23, and then when gold uh, broke back below 1275, we stopped out. So we stopped out at about 13, and then we re-entered right back down here. So the metals portfolio is already back up at its all-time highs. Actually, it's a little above it. I think at the open today we're going to be somewhere between up 130 and 140% in the metal portfolio. But the nonsense about how people destroyed their portfolio is just that. It's just nonsense. And I'm going to tell you that before this bull market is over, JNUG is not going to go back to $23. It's going to be over $500 and probably over $1,000 by the time this bull market is over. So all of these people, trying to you claim that we destroyed our portfolio and stuff. They're just idiots. Bull markets, this is how bull markets work. Any long position will be rescued in a bull market. You have to have patience. The moves don't occur overnight. You're not going to be able to be a day trader or a very short-term trader and make much or any money in this bull market. But for those that have patience, those that can trade against the consensus of the crowd, contrarian traders, or people that can hold old turkey, you are going to make a fortune over the next 4 or 5 years. And it doesn't matter if you time perfect entries or not. So here again, I'm going to point this out. The volume in the triple leveraged fund, the JNUG, you can see the as we neared the bottom here, and then as we started out of this intermediate yearly cycle low, you can see this massive surge in volume. That occurs as big money is getting into position for a huge run. So I'm going to tell you that JNUG is going to go. It's going to rally 500 to 1,000% during this intermediate cycle. The short-term traders and the day traders, that they're probably not going to make anything off that run. But for those of you that can, trade like a professional trader, take your position and just hang on and quit worrying about, the daily wiggles, 1 or 2 days underperformance by the miners, and just hang on through the intermediate cycle advance, which should still have 2 to 4 months to go. You're going to make a lot of money, and you're probably easily going to recover these all-time highs and probably make new highs before this intermediate cycle tops.